The chemicals and explosive manufacturer AECI reported a 59% drop in first half headline earnings per share to 108 cents. So after being hit by the cost of a BEE deal, shares in the largest maker of explosives in Africa dropped 2.8% to 83 Rand and 85 cents. Company's mining explosives business was hit by supply constraints of ammonia. Company CEO Graham Edwards joins us in studio to break down the numbers. Hi, Graham. So let's look at those big picture numbers. The revenue up 17% to 6.9 billion. It gives an idea of the scale of the numbers we're talking about. You did pay a cash dividend of 78 cents per share. Always good to have a dividend in these times. The investors looking for that. But your headline earnings down, and there was that BEE deal. So how much was the BEE deal and how much was tough operating conditions?
Including the BEE deal, the headline earnings were down 59%. Without the deal, it would have been down 9%. So on the trading profit level, it was almost flat. So there were a few interest and post-retirement medical aid charges which came in below the trading profit level. But I think a little bit of a disappointment to us is that not more of the 17% increase in sales were able to go through to the trading profit line. And that is an indication that we found the conditions fairly difficult, particularly in the chemical area. And as you discussed there, we did have some supply chain problems, particularly on ammonia, in the explosives
also
business.
Suggests costs. You know, as a simple rule of thumb, I say if the revenue is up by 10% and the earnings are up 15%, you're doing something very right. And if it's the other way around, where's the problem? Is it costs also?
Well, in the chemicals, when it wasn't really cost, it's a mix issue. Let me explain what I mean. The actual volume was up by 12%, but the traded volume, the products that we trade in, others we just import them, buy them and sell them, was up 33%. And the manufactured volumes, the stuff that we actually add value to, was down 7%. So there's quite a big mix change in terms of those traded volumes go through at a relatively low margin. And in that sense, I guess we're like a microcosm of the whole sort of manufacturing sector in South Africa, in that it's starting to become cheaper and easier to import products than it is to manufacture it yourself.
The word you use in your exposure to mining and manufacturing is volatile.
Yeah, the mining side was volatile. I think the volatility hit us there, and that was Mark was referring to that a little earlier. We had a shutdown. We had a planned shutdown of our nitric acid plant, and we had a planned shutdown of our ammonia supplier. So none of that came as a surprise. The issue was, in front of that, we had to build up stock so that we'd keep our customers supplied. Now, when we bought the stock, the ammonia price at that time was like 5,000 Rand an ounce, Rand a ton. And when we sold the product was like 3,800. So unfortunately, there was a big loss in terms of the actual stock that we built up in order to keep the customers going. And that amounted to a total of 50 million Rand for the period.
Mark?
You've been through a period, Graham, of pretty good investment in the company, modernizing, moving up the value chain. So it's been a good few years for you, by and large. The tone in your presentation today was mildly upbeat, in fact, and that's sort of encouraging, particularly given the gloomy stuff that we've just been talking to. Perhaps you could just give us some brief sense there.
Yeah, sure. Look, I think there is gloom and doom, particularly in Europe, and it is clear also that America is going to be pretty pedestrian in its growth. However, what we're looking at, what we're exposed to, is mining volumes. So we're not exposed to mining prices, mining volumes. Now, obviously, the two in the longer term are linked, but in the medium term, not necessarily. Also, we must realize that mining volumes, if you look at like copper or iron ore, mines around the world are getting mined out. You've got to bring on new mines just in order to keep the mining volume at the level where it's at. What we are actually seeing, particularly in the rest of Africa, there's a lot of new mines going down. These mines are starting up. We've been invited to tender for the business. We've actually been awarded the business. So we see a pipeline of business coming towards us, which is based on volume. Now, I'm not saying anything is going to be completely independent of big sort of shocks. As Kevin was saying, we're living in different times. But certainly what we see is relative growth in terms of mining volumes. The only exception to that is probably platinum. If you look at the platinum industry, it really is in trouble.
You mentioned actually how your exposure to platinum through your division Senman was affected.
And our explosive division is also, but it's about 23% of our revenue into mining goes into platinum. We're expecting that about 10% of that platinum market needs to go away. The platinum price will remain low until some of the mines close down and that platinum supply reduces by about 10%. Yeah. At that point, I think the prices will stable and the market will move on.
The market is adjusting. The supply is being reduced, Kevin.
And just historically, as as AECI has had to work through these cycles, how long can that disconnect go on for? In other words, you have falling mining prices without falling mineral prices without falling volumes.
Well, the case study really is probably the underground gold mining industry, and there you see step changes. So what you tend to see people doing is they run the mine absolutely flat out because they're price takers. So the only way they make money is to get as much volume as they can. They run the mine flat out until it's cash negative, and then they close. Yeah. Now and it now depends on the mining and the company and the pockets that they've got. But typically you won't run for very long below your cash costs. And I think certainly in the platinum industry, a lot of the smaller companies, some of them BE deals, are going to be under a lot of pressure very soon if the price stays at this level. And that volume needs to go out of the market.
Graham, and the tone of your presentation was mildly positive, but I felt it wasn't quite as positive as last year. Is that just a realization of the environment that you're in and looking at the operating environment, or?
It is. I think we are trying to be a little more cautious, and I think we're taking into account the gloom and doom that we discussed. We're taking into account the fact that it certainly doesn't look like there's going to be a big driver in the West. But as I said, we still see those volumes going relatively well in mining. I guess the difficult side we've seen, as we were talking about, a lot of our chemical volumes go into the South African manufacturing sector. And that has been, as I said, that's been kind of hollowed out.
Yeah. Graham, they also announced, or you announced in your statement, that you'll be retiring. You're an AEC lifer. Highlights, lowlights, a career of blowing things up?
It was, and that was one of the lowlights, in fact. I think the worst times I've ever had in the business was when we had big accidents. And I can remember one happened the day before my 40th birthday. Had a big accident. It was just terrible working through those things. So probably the highlight of my career is really being a pioneer and bringing in the new technology, which took away that old nitroglycerine-based technology, which was the product that used to create these big accidents, and working with the mines in the underground context, doing pumpable explosives, which only becomes an explosive once it's in the hole. That was probably the highlight of my career. It really was something that I enjoyed doing.
Well, we wish you a happy retirement. You don't look at all sad about going on to do other things. Thanks to Graham Edwards, the CEO of AECI.